Hi everybody. Today, in this short video, I will summarize for you how financial markets work. Whether you are a novice or an expert, stay with me to discover the fundamentals of trading. Imagine a huge global market where supply and demand intersect. All this takes place on the primary markets, where new assets are born, and the secondary markets, where these assets are exchanged between investors. The different types of markets are broken down as follows. Capital markets, where stocks and bonds are born and circulate, money markets for short-term transactions, and commodity markets dedicated to tangible assets like gold and oil. As a trader, we operate on the secondary market and work with supply and demand areas. Now let's see which products we are going to support. I will only talk about the main ones here. First of all, the stocks. When a company decides to go public, it conducts an IPO by issuing new shares. These shares are then traded on the primary market. Once a share has been issued in an IPO, it can be bought and sold between investors on the secondary market. Examples of secondary markets are the world's major stock exchanges, such as the New York Stock Exchange and the Nasdaq in the United States. We can deal directly with stocks, but also with other financial products such as options, which give the right, but not the obligation to buy or sell an asset at a predetermined price. Now let's talk about index. Stocks are listed on a stock exchange with a buy price that represents supply and a sell price that represents demand. The price at which a stock trades depends on supply and demand in the market. Stock index, such as the S&P 500, group together a set of stocks to represent the overall performance of the market or a specific sector. These index serve as benchmarks to evaluate portfolio performance. To conclude this video, I will tell you about the different contracts that I use to speculate on the financial markets, because trading is not investment, but speculation. If you want to invest in medium to long term, you should turn to investing in stocks or ETFs. Future contracts. They establish an agreement to buy or sell an asset at a future date and at a price agreed in advance. Often used to hedge price risk or speculate on future price movements. You actually own the asset to trade. Contracts for difference (CFD) allows you to speculate on price variations of underlying assets without holding these assets. They use leverage, which amplifies potential gains, but also losses. There we go. I hope this content will interest you. If you have any questions, do not hesitate to leave them for me in comments. In the next video, I will tell you about the intermediaries who give you access to financial markets, and who we call brokers, and which broker to choose depending on the products you want to trade. See you soon.